Welcome to our lesson today. We are now getting to lesson 4. I hope you have watched the previous lessons, and now let's talk about, or we learn about, accounting equation. First of all, we will get to know what is accounting equation. Remember, as an accountant, you need to know many things, and one of the basic things that you need to know in accounting is accounting equation. It will assist you in every entries that you are making in preparation of financial statements. This is the fundamental part of our work, learning about accounting equation. So let's define accounting equation. Accounting equation states that at any point of time, asset of any entity must be equal to the total of the owner's equity and outsiders' liabilities. That means what you own in the business, it constitutes what the owner has contributed and what has been borrowed from outside, that is outsiders' liabilities, so they can assist the firm or the entity in operation. So now, this means that asset is given by the sources of finance. And what are the sources of finance? It is owner's equity and outsiders' liability. That is the equity, which is the capital, plus the liabilities. So these components now forms our accounting equation, which is given here, that asset is equal to capital, which is equity, plus liabilities. Let's define or have some explanation of each and every term in our accounting equation. Starting with assets. Asset is resources of a business with which the business controls with expectation that it will give economic benefit in future. These are property or items that exist in the business that the business has the control over, with a name that at the end of it all there will be that benefit, which is economic benefit. We usually have two categories of assets, that is tangible assets and intangible assets. Tangible assets are those assets which are physical and you can see them. These are like land, building, plant, machinery, equipment, furniture, investment, cash, and as listed in this explanation. We have intangible assets. These are assets that cannot be seen. They are like patent rights, trademarks, goodwill. That is all about assets. We will talk about assets in most all dimensions of doing accounting work. Let's define capital, or check to know what is capital. Capital is internal financing by the owner. This is the money that has been brought in, or the financing that has been brought in by the owner who is starting the business. When we talk about limited companies, we talk about the shareholder or share capital. The shareholder bring in the capital in the business to start the business. But for the owner, we just talk about the capital itself. We have items that affect capital. One being profit or income. This has effect in increasing the capital. Whenever there is income or revenue earned in a business or a profit, it increases the capital. Another item that affect the capital is loss or expenses. Expenses have effect in reducing the amount of capital that exists in the business. So if there is any expense or any cost that is involved in a business, it has the power of reducing the capital. The other item is investment. Investment refers to the additional capital in the business. So when you come, we have already started the business, but you want to increase the capital, you earn more investment. That investment increases the capital. We have the drawings. This is the drawings from the business for personal use. They have the effect of reducing the capital. Let's go to the other component of the equation, that is liabilities. Liabilities, these are obligations of the business to others or outsiders, e.g. loan or creditors. Loan, this we get from financial institutions, so they give us loan which will be paying interest. That's our duty, that's our obligations to pay interest. So that is our obligation as a business. We have creditors, these are persons who we have received goods from them on credit, and we have responsibility of paying those goods that we have received. Now that we have learned the components of the equation, let us interact with the equation by an example. So we have an example here with just 4 transactions. We have examples with more transactions, but this will help us know how to interact with accounting equation. And remember, we are still going to the accounting equation that asset is equal to equity plus liabilities. So let us see how the transactions that we have seen there can affect or will be affecting the asset, equity, or liabilities. The first transaction commenced business with the cash 50,000. Yeah, started a business with cash 50,000. So this 50,000 has been brought in by the owner of the business. So what will happen has brought in the cash. Cash itself is an asset, and the money has been brought in by the owner, and we said the capital is what has been brought in by the owner when starting the business. So this amount constitutes the increment in assets and increase in the equity or the capital. So the first entry that you have is the cash will increase by 50,000. That is, the cash has been brought in, and this is the capital of the owner. So the capital of the business, which is 50,000. So that's the entry from the first transaction. Let's go to the next transaction. The transaction number 2 is purchased goods on credit, $30,000. So you have purchased goods or inventory on credit. Here we have increased the goods in the business. So our inventory has increased by $30,000. That is $30 inventory increment. The other thing is we purchased on credit, meaning we have creditors coming in. We have now obligation, like the way we said, we have a responsibility. So this is our liability. So our liability of creditors amounting to 30,000, which increases our liability. That is the entry of that transaction. Let's go to transaction number 3. Rent paid $500. Rent paid $500. Rent is an expense. Remember, we have said that equity or capital is usually affected by expense. How? In every expense in a business reduces the amount of capital. So this means that this rent paid 500 will reduce the capital, and it is paid. We have the cash that we introduced in the business. So even the asset reduces, the cash that we will pay this rent with reduces the asset. So the asset reduces by cash 500. Then our equity will reduce because of this expenditure or this expense, rent, by 500. So that's how it will be viewed, that the asset reduces by 500 and we will have a rent expense of 500. Let's go to the other transaction. Paid suppliers $30,000 in settlement of account. When you hear about settlement of an account, it means there was a certain debt that existed in the business and we need to cover it, or we have to pay it now. So by paying, and if you check, that was in our transaction number 2, where we bought an inventory or goods on credit 30,000. So we are paying this, or we are settling the debts. So what will happen here? You paid suppliers $30,000 in settlement of account. You paid. So asset reduces. That is asset cash reduces by 30,000. What will happen to our ability? We had our ability of 30,000. That's our creditors. So we'll have erased it or we have covered it. Meaning we have reduced what we were having as a debt from outside. So the first entry is reduction in cash that will be used to pay the creditors. So the cash reduces by 30,000. Then we will have on the other side the supplier, the creditors reducing by 30,000. So sorry, that this is not cash. It will be then this will be the creditors. Sorry, it will be negative of creditors. So creditors that will be the creditors instead of a cash, but the amount will be 30,000. Thank you very much. Remember to subscribe to our channel to have more and more videos that will guide you and you'll be able to learn and become an accountant. Thank you.